Hi everybody, warm welcome. Good to see you. I'll come back onto the program. I'll come back onto the program at the end. The Forex funded accounts. They start at 5, 10, and 15,000. Those are the evaluation accounts. You can choose which you start at. So it's either 5, 10, or 15. It is an evaluation account. We are evaluating you. You're evaluating us as well. You're also evaluating your approach to the markets, and within a very conservative list of rules and risk and money management rules. So that's where you start, and once you've got through that first level and you're happy with it, and you've proved to us that you're can be consistently profitable over a period of time, you actually have 12 months to do the whole to achieve a very simple profit target, which you get a portion back as a bonus anyway, and we continue paying you profits at a higher level as you move up the program. But once you've moved through that initial phase of the evaluation accounts from 5, 10, and 15, we then multiply those by 4. So your next level up is then, if you're on 15,000, you go to 60,000. And from there on, we start doubling it. So from 60,000, you go to 120, and from 120 to 240, and you work your way up to 2 million. So you get up there pretty quick. But the risk and money management rules apply right the way throughout the program in exactly the same way. But I'll cover it in a little bit more detail at the end. This is on the workspace for the three indices. I've got the YM, the NQ, and the ES, top line on 5-minute, bottom line on daily. You can see what's going on. We've got the volume point of control here. This is the chart you were looking at earlier with Anna on 5-minute. There we go. Volatility trigger. What do we get? Reversal. Where are we going? Back to the volume point of control. You know, it's all very choppy at the moment. Trying to break away on the NQ. This is the divergence we've got at the moment. We've got we had a big down day yesterday for the NQ after the initial surge, and then it collapsed like the souffle that we use as an analogy for a lot of this type of stuff, where you get these rapid moves. We've seen it time and time again through over the years, particularly around Brexit, Euro news, elections, all that sort of stuff. It's an ideal opportunity for the market makers to move the market rapidly in one direction and then to deflate it in the other. And it's just a great money-making regime for them. Oops, sorry, clicked that off by mistake. Just bring that back again. Where was that? Where is it? Must be that one. There we go. Let's just move the chat box out of the way. Move that over there. This gives you an idea of what went on yesterday. This is the huge wick to the upper body. Lots of volume under there. You know, it's not looking particularly strong, and it's what we expect to see. And over on the YM, moreover, on the daily chart, we've got a volatility trigger. We expect to see congestion. We expect to see it moving around in there. And in addition to that, when you look at the volume associated with that particular candle, it's out of whack. Why? Because if you look at the volume associated here with this particular candle, just to take an example, in fact, you could take any candle through here. If this were a legitimate price move, this volume should be at least 1.5 times that, possibly even double that, and it isn't. You've got bigger down days here with more volume. So you've got an up day on relatively, let's use the word, modest volume. There is nothing across here that would suggest that that is extreme. In fact, if I pull this over, you know, we've had bigger days over here, over in March with the extreme volatility. So it just gives you an instant clue that this is not a genuine move. This is on just rumor. This is an opportunity. It's an opportunity to rack the market up, to trap a lot of traders into weak position. It was fantastic trading yesterday. I have to say we made a bucket load of money on the yen markets because we've got some long positions across the yen complex. Pretty much all the yen pairs are in a big portfolio there, and we were making money very, very fast yesterday. Obviously, we are long those pairs. In other words, we're selling yen, and we're still holding those positions. They're not intraday, they're much longer term, which actually makes the point that we do talk a lot about short-term trading here, but that's purely for the purposes of examples and so on and so forth. There is no prescribed way to trade the market, whether you're a out and out scalping trader or whether you're taking a longer term approach. The principles are exactly the same. Just seeing what's going on here, we're coming back down. If we go up into the YM5, we've had the reversal. we're back to the volume point of control. We've got a ton of volume sitting in underneath here. So if this is going to penetrate, then we've got to see rising volume in the downtrend, which we're not at the moment. We're seeing volume falling away again. So the participation is not lacking. It's lacking. It's not following through at the moment. We're not seeing that momentum in the market, and we like to see more congestion. Just to pull over the VIX, got that over here. Just pop that up full size. There we go. This is on 1, 5, 10, and over onto the daily. You can see what's going on in the VIX. It's pretty much the same as a lot of the other markets. It's very choppy. It's very sideways price action, and that's where we are at the moment. So it's just keeping an eye on that to see what's going on there, keeping an eye on bond yields and all the rest of it. Let's go over to the individual workspace. I've got the YM here. Here we go. It's just breaking, and as I said many times before, this is on 15-second. This may not, you may not be comfortable trading this, but when markets are in this particular phase of price action, where the price action is relatively narrow, if you are going to trade, then you're going to have to move down to a much faster time frame, certainly sub a minute, if you're an out-and-out scalper. But even there, you will find volume price analysis works in exactly the same way. We had this price waterfall. There's several aspects to this particular price move. First of all, you'll see the resistance that was coming into play up here on this blue dashed line. This is on the accumulation distribution indicator, which works solely on price. The thicker the line, then the stronger the area, and the way it does that is like Popeye and his spinach. The more spinach he eats, the bigger his muscles grow, and it's exactly the same. And it moves around all the time. It's actually moved because it's been tested somewhere previously. It's added that into the algorithm. So these are constantly moving up and down the whole time. That's the level there. We then come down into this wedge of volume on the volume point of control, because volume works in exactly the same way. You can see it in action here. We had low volume in this region. So when the price action is approaching that area, what do you expect it to do? You expect it to move through here pretty rapidly, because there is, first of all, you've got no price-based support coming into play. This is very minor. This is very minor, what was support at that point and then becomes resistance. But in terms of volume, it's very light in this region. So from a trading perspective, we expect the market to move through there. Why? Because there is very little in the way of resistance from a volume perspective, as opposed to resistance or support from a price-based perspective. So you're using the two indicators, the support areas and the volume areas, as information for where that particular trend is like to either move very rapidly through or is going to find some reason to pause and congest. Obviously, as we get down to the volume point of control here, which is the yellow, which is the fulcrum of the market, that is the point at which the volume is the greatest. It's out here. It's exceeding this area. Now, at this point, the volume point of control might have been up here. I don't know. It could have been. And then it moves down here. It's not a fixed thing that stays anchored in place forever and a day. It moves around as volume builds and rebuilds all the time. But for the time being, it's anchored here. We've got a platform of what was potential support in underneath, which was quite strong. That was breached. We're moving down through here. We're moving down into a lower volume area. What's nice about this example here of the price waterfall is that you can see a classic example of rising volume. That's what you expect to see. Why do you expect to see that? Because it takes effort for a market to fall, and it takes effort for a market to rise. It's exactly the same principles. So you see rising volume in a falling market, rising volume in a rising market. If that trend is going to continue, if it isn't, then you'll see the volume falling away. And that's a classic, one of the classic applications which we do in great detail in the education program, which is to teach you how to interpret the difference between a primary and secondary trend. Because what that means is, if you can interpret that correctly, when you're in a primary trend higher or a primary trend lower and you get a pullback against you, then you can interpret whether that trend is a full-blown trend in reversal, in other words, primary to primary, or is it just a primary into secondary, and you're going to see the primary reconnect in due course. You've got the trend monitor here, which is flashing bright red the whole time. It's keeping you in, holding you in this move. And the trend monitor was designed with one simple idea in mind, to give you the confidence to hold a position and not be scared out. And that's what it does. It smooths out these congestion areas, keeps you in, keeps holding you in. Now we've got a volatility trigger. What do we expect? Snaps to the upside, people jump in, trapped, down it goes. And that's why volatility is so important. That's the power of the indicator, because what it tells you is two things. First of all, the market makers are involved. And secondly, it tells you the price action has moved outside the average true range, and therefore to expect either a reversal or at the very least congestion, neither of which you want if you're trading a trend, because you just want to carry on trading the trend. You don't want to sit in congestion, and you certainly don't want to see a reversal against you. If you're in a position and you get a volatility trigger, if you're in profit, great, get out, close out, take it all off the table or most of it off the table, and just sit tight and wait for the price action to move on. But in this case, it's just a classic trap move, not much volume there, snap it higher, traders jump in, because it's the fear of missing out. It is that emotion that is triggered. When you see a fast moving market, your reaction will be to jump in. It's fatal, because inevitably what will happen is the market will either congest or reverse. As I say, even sitting through congestion is painful. We're now continuing lower. We had a little bit of a transitional color on trend. We're now going back into the red again, so we're picking up through again. Nice move lower. You know, these are decent points we're talking about here. We're now, 90 points here. If you got in on at the top here, we're now talking a whole heap of points. We're talking, 100, 150 points. And at $5 a point, that is worth having, I can assure you. Just pop that lower. Now we're back to looking at it in multiple time frames and giving us the slightly zoomed out picture, if you will. We're moving a little bit further away now from the very tight, close, coal-face price action, and now we're looking at it from a multiple time frame perspective. What are we seeing? Similar sort of picture. We've got the trend monitor, which is nicely helping us stay in this particular move. We're starting to break away from the volume point of control. We've got some nice rising volume here. We're moving down into a low volume region here, so it should move through there pretty quickly. I'm also looking over on the right-hand side. I can see the VIX snapping up. I'll just pull it over very quickly for you. You can see what's going on there. There we go. This is the VIX snapping up. That's why you're seeing this move on the indices, and you'll see it reflected in risk currencies as well. Up onto the 3-minute. Let's have a look and see what's going on in the 3-minute. We can see our trend monitor has transitioned there. A lot of choppiness, a lot of weakness coming in here, a lot of indecision. Then we're moving lower. Trend monitor's red. We're starting to push down. Volume's not great here. I want to see more volume under this one. Volume point of control, the volume histogram there is pretty low, so that's nice. Let's go up onto 5. Similar sort of thing here. Now we're diving down. Let's just head back onto the multiples and see if that's reflected across the piece. We're on the YM there, but let's just double check. Here we go. The NQ was negative anyway. This is what's going on, and when you look at it from a daily perspective, it doesn't look much of a trade, but down at those fast time frames, there's plenty of money to be made in there, I can assure you, and it's developing here on the NQ. That's continuing to push lower. Where is that going? Back down to the volume point of control in due course. So there's another 300 odd points. I'm not going to say it's going to get there today, but over the course of time, maybe in the next 2 or 3 days, that's where it's heading. Similar sort of situation on the ES. We had this very, very strong signal of weakness yesterday, big wick, as I mentioned earlier on, decent volume under there. That's not going anywhere, selling off. And we're all going in the same direction now, which is a great comfort. When you're trading an index like this, it's a great comfort to see all 3 of them going in the same direction. What it also gives you is a different perspective from a volume perspective. This is 230, the volume is low here. This is through on Globex, so this is electronic only. Now we're trading electronic and cash markets in tandem, so the volume spikes at 230, as always does. That's what you expect to see. You expect to see lots of volatility at the open as well. Wait for the market to calm. Now we're starting to see a decent trend beginning to develop to the downside. Don't know how long that's going to continue. Just keep an eye on the VIX over on my right-hand side. It's still ticking up. It's 25.57 now, and it's ticking up on the day. Yeah, that looks all fine. On the 10-minute, I've got it in a volatility trigger, but I want to see that really climb up to 26 and beyond if this is going to continue. So that's where we are on the indices. Let's just see what's going on elsewhere. Let's call in on gold. Gold had an absolute rip-roaring down day yesterday. And sorry? Yeah, dumping safe haven, as Anna said, huge down day, very big down candle. But as you can see, we had the volatility trigger. So what was the expectation for today? The expectation is that it's not going to sell off further. The expectation is congestion and a regrouping, if you like, and a possible recovery in due course, because if the indices continue selling off to the downside, I know it will depend to some extent, obviously, what the US dollar does. But certainly the overreaction, the overhyped reaction, the market reaction yesterday, that was also reflected in gold, and that's starting to recover, which is what we expected to see. Similar situation on silver. Similar situation on silver. Volume point of control here, we're trading around inside the spread of that particular candle, which is what we expect to see. And then up onto, let's go and have a look at oil. Round up on the commodities. Oil's been in a huge congestion range for a long time. It's capped off around the $42 mark. You can see it do at $42 a barrel. This is the region that's really holding it down. But whilst the technical picture is one aspect of oil, the big dominant picture really is one of overall supply and demand, or a lack of demand, if you will. And until OPEC decide to step in and begin to cap supply, then oil is likely to continue trading within this relatively narrow range. From an intraday perspective, doesn't really make much difference. You're just trading long or short, depending on what the price action tells you. But from a longer term perspective, that is where oil is likely to trade for some time. But as always, you know, the price action is exactly the same. It almost doesn't matter what's at the top of the chart. The indicators work in the same way. Volume price analysis works in the same way. You can see here we've got a price waterfall. We've broken away from the volume point of control. We broke through this platform of support, which came into play at this level here, went through that, breaking lower, much lower volume here, sped through this very low volume region here. Now we're starting to build some heavier volume in this area here. We've got a volatility trigger here. We've got another one here. We had a 2-bar congestion in here, so we paused into that, but continuing lower. Ton of volume under this one. And on we go down the chart. You can also see this is a minor example, if you will, of the power of VPA, because what you're seeing here is an effort to rally, volume falling away, another effort to go up on low volume. Where is that market going to go? Only one way, downside. And that's really what I was talking about in terms of looking for those opportunities where VPA gives you assistance in identifying whether we are changing from a primary trend to a primary trend lower to a primary trend higher, or whether we are simply moving into a secondary or tertiary trend where the market is just going to move sideways, but we're actually going to pick up the longer term trend. And the reason it's so important is this, very simple. Most traders will get shaken out of a strong position very quickly as soon as the market pauses, because your natural reaction is to bank what you have. It's our DNA. We're all programmed the same way. It's a natural reaction. If you do that constantly, all you will end up with is a load of small losses and a load of small profits. It works against you. You have to have some bigger winners, which there are fewer of them, but they outweigh the greater number of smaller losses. And that's the mathematics of trading. It's as simple as that. So you have to find mechanisms which help to keep you in when you've got a decent trend developing, to maximize the profitability and not get bounced out at the first opportunity when the market pauses, because no trend goes up or down in a straight line. It's as simple as that. Lots of volume under this one. Market makers are the big operators and market makers have moved in. We've got volatility trap. In we go. Now we're going to see a reversal coming into play. You know, that's what you're expecting. So if you're expecting that, get out. You know, it's as simple as that. Just get out, bank your profit, wait for this to settle. If the market breaks below 40.70 and reverses again, fine, you can jump back in again. But for the time being, you've made a decent slug of money in here. Enjoy it, close out. You don't want to sit through congestion. You certainly don't want to sit through a reversal. If the market does carry on lower, the trend monitor hasn't transitioned yet, as you can see, but if it does carry on lower, then you just jump straight back in again. What have you lost? Okay, you've lost a bit of spread in here. Cost of a futures round lot is, you know, is not a great deal of money now. Peanuts, frankly. Okay, let's see what's going on in terms of faster time frames. Okay, that was 15 second. We've got exactly the same thing going on here, so that will just confirm what we're seeing on 15. We haven't got volatility here. We've got a ton of volume coming under here though. So we're looking at a possible reversal. We've also got, we're down onto the 5 minute. We were coming off down to the VPOT, but we also had this huge amount of price support coming into play. It almost reached that level at 40.70. And it's another aspect of trading. If you're looking at something on a chart and you're saying, you know, a nice move, you made some money in there, you're looking at this 5 minute chart and you're thinking, is this going to go straight through or is this going to find some difficulty? Well, clearly you only have to eyeball the amount of price action over here to get some sense that the market is hardly going to go through there with ease because you've got a ton of price action sitting there. It's confirmed with the accumulation distribution. When you get clusters of these two, these are very strong. This has been tested together. In fact, you've got another one in there. So you've got a cluster of 3 in here. You've got 2 very strong regions and a weaker region, but together they act in concert, providing this very strong potential platform of support. So even if the market had got down to 40.70, it would inevitably pause at that level and almost certainly congest, if not reverse. Let's go back onto the indices again. There we go. Where do we leave it? Let's see. Okay, it's pausing a bit. What's interesting is the VIX is still ticking up. Let's go up onto back onto 15 second again. Okay, up onto 15 second. We had a little bit of buying came in. We're trading around the volume point of control. Are we going anywhere? No. Buying coming in here. We've got a little big wick to the lower body. Lots of volume under there. Is that selling? No, there's buying coming in there. That's fine. This little rally up here is fine. Nice spreads, good volume, rising volume. Then what do we see? Anomaly, volume, hasn't gone anywhere, weakness, wick to the upper body, good volume under that candle. If this was going anywhere, then if you compare it to this candle, which has got this amount of volume, this has got a little bit more, but let's say it's the same. Well, the candle should have gone up here somewhere, and clearly it hasn't. It's been capped off by this very strong area of resistance in play. We're now going back down onto the volume point of control. It's all looking very weedy. And in addition to that, the VIX, as I say, is still climbing. Just pull that over. The VIX is high because people are buying volatility on the outcome of the presidential election, which is still, wouldn't say in doubt, but it's certainly going to be dragged on for a bit. There's uncertainty of not uncertainty of outcome probably, but certainly uncertainty in terms of when it will be resolved. And that's why the VIX is so high. It's up at 25. It's been up in the 25 to 30 range for weeks and weeks and weeks. And that's why people are buying volatility ahead of the election. If you're looking at this as, let's say you're looking at this as a trade to the upside now, personally I wouldn't be, but you know, if you were, what's in the way? Well, you've got this area, you've got this, you've got this, you've got quite a lot of volume here. Is this going to move up through here pretty quickly? Unless there's some piece of news, wouldn't say so, but it's, you know, this is what you're looking at on the chart the whole time. You're looking at it from the perspective of where is this trade going to struggle? Have I got enough to deliver against my risk? If I'm prepared to put $100 of risk on the table, do I want to look for $100? Is $100 enough for me? Is $200 return enough for me? But it's from a chart perspective. It's not this nonsense of risk and reward rubbish, which a lot of traders promote, which is absolute nonsense. The market doesn't care whether you need a 3-to-1 risk reward ratio or 2-to-1, whatever it may be. You basically look at it from a chart perspective. And again, it's something we explain in great detail in the education program. Let's just have a quick whiz round, see what else. Let's go to currency futures for a moment, see what's going on there. This is on the currency futures. I've got the 6A, the 6B, the 6C, and the 6E, 6J, 6N. So I've got Aussie, pound. This is CAD dollar, not dollar CAD, because it's inverted. Everything is quoted against the dollar. So it gives you a straight view on the US dollar. So this is CAD dollar, this is Euro dollar, this is Yen dollar, and this is New Zealand dollar. So you're simply looking at the dollar as the counter currency in all cases. You can see the dollar over here flip-flopping around. We saw quite a bit of that this morning. There's quite a lot of twisting and twining of the currencies, which give you a sense of whether there are strong trends developing at the moment, and whether there are opportunities. And it's what that is saying. This is on 5 minutes, I think. Yeah, I'm sorry, 15 minutes. On 15 minutes, this is what we're looking at. We've seen some decent euro buying. And you'd be looking at, well, what would I be buying it against? Possibly against New Zealand, which was falling sharply at the time. So there's an opportunity there. We had the CAD rising, that's now rolled over. The pound was being bought quite strongly. That's now started to roll. So maybe from a longer term perspective, you might be looking at selling the pound and buying New Zealand or buying Aussie, something like that. But in terms of dollar, not a great deal of choice. And where you see the currencies moving together on the indicator, it will tell you straight away there's no trades, because if you've got the dollar rising and you've got the yen rising and you've got the New Zealand rising, there is no divergence of effort. In other words, you're not seeing strong buying counterbalanced with strong selling. So the trend is therefore weak. There may be a very minor trend, but the analogy I always use is of two trains leaving a station, where one is moving relatively quickly and the other one is perhaps moving less quickly, but the actual differential speed between them is minor. The greatest momentum, if you like, will come where you have two trains traveling in opposite directions towards one another, clearly. And that's really what it's about in terms of digging out the opportunities. Where are the best opportunities? You can see them starting to set up with the pound, for example. So if you went and had a look at a pound New Zealand chart, there is a trend starting to develop there, purely because you've got stronger selling of the pound and you've got strong buying of the New Zealand dollar. Just go over onto the spot. Where are we? I'm not sure what pair I've got on here. New Zealand yen. This is pretty much symptomatic of what we saw across the yen complex yesterday. Massive up candles, volatility triggers on the daily, hugely important, hugely significant, and really telling you loud and clear, don't expect much price action today, certainly not to the upside at any rate. Expect congestion. It's what we're seeing pretty much universally across the all the currency pairs, or certainly the yen pairs at any rate, where we had this massive spike, massive selling of the yen on risk, which was terrific, very, very profitable. But now we're just sitting tight, waiting for the opportunities to develop over the longer term, and not expecting too much to happen in terms of those particular currency pairs, which is what we're seeing right now. Okie dokie. Right, let's, I think at that point, I'm actually going to wrap up just to bring everything together. Let me just start with the Forex program. This is the Forex program. As I say, you start at that level, the evaluation level of $5,000, $10,000, and $15,000. It is a no risk proposition, because you're not using your money, you're using our money. And therefore, as you would expect, there are risk and money management rules. But the time you have available to complete the first step, which is at the evaluation stage, which is a very simple profit target based on the initial trading capital in that particular account, which is 6%. So on a $5,000 account, it's looking for you to achieve a profit of $300, of which you get 30% back at the end of that particular phase. And then once you've completed that, and you have 12 months to do this in, so you have plenty of time. You can also do it in any which way. It's what suits you as a trader. It can be any style you like. There's even hedging available. It is on MT4. and you just take your time. If you're a scalping trader, that's fine, but if you're a longer term trader, then we give you 12 months to complete that. Once you've done that, there are no other time limits on any of the other levels. You just move up to the next level. As say, we multiply your capital by 4. So on 5, you move up to 20, and the mid one, the 10K, you move it up to 40, and on the top one, you move up to 60K. And at that point, you can trade, and you're also receiving your profits back on a monthly basis at the rate of 40%. And that's really it. And the rules and the risk and money management rules which wrap around it apply throughout the program. And they are there to give you and help you to provide a disciplined structure, and also obviously to protect our capital as well. So it's a win-win situation. So that's the program. You'll find all the details there. It is only available to students of the Quantum Trading Education program. So you will not find any payment links. Those are inside the program themselves. But you will find the details here if you're not a student of the program. But we've created it to give our students the opportunity to leverage their skill and knowledge from what they've learned in the program, to then take that forward and put it to good use in a large funded account, but starting at a relatively low level, so that you are comfortable with trading, and we are comfortable with you as a fully funded trader. It's as simple as that, but it gives you that complete upgrade path right the way through, right the way up to $2 million. In terms of Anna, you'll find all Anna's posts and analysis over on her site, annacooling.com. You'll find all the books on Amazon. They're either in Kindle version or paperback. So they are all there. And all the indicators you'll find here at quantumtrading.com. Obviously, if you join the program, you get a full set of indicators anyway. In addition to that, if you invest in the full set, then you are entitled to receive all future indicators we develop for those platforms free of charge. It's just our way of saying thank you for investing with us. MT45, NinjaTrader 7/8 and TradingView. We will hopefully be launching TradeStation in the next couple of weeks. Possibly next week at the latest. So that will be up and running. That'll be 9.5 and also version 10. So 9.5 is if you have an Interactive Brokers account, you can link it straight through to TradeStation, and version 10 is TradeStation Securities. It's a wonderful platform, very exciting. We're delighted to be working on it, and it'll be great to bring it to market. And we will be doing separate webinars with that particular platform. Once we've done that, we will be dropping back onto TradingView, just to bring the other indicators across, which we couldn't port there before because of the Pine script. It didn't give us the functionality in terms of object and line drawing, but it does now. So the TradingView package will have all the indicators as well. And when they are there, that package will be aligned with MT45. So if you're thinking of investing, it's a great time to invest because you get it free of charge. As soon as we've finished that job, then TradingView package will align with MT45 at $894. That's it. Hope you've enjoyed today. I'll just pull the chat box across, just see if there are any other questions. Oh, you do have an IB account? Fine. Well, that might be one alternative for you to consider, is to look at that as a particular option. So there we go. Yes. Oh, hold on a minute.
Sorry, I might go on.
Yep.
Yeah. I've answered all the questions about the program. I sent the link.
Right. Sorry. Hold on a minute. Sorry, Anna's just talking to me. Sorry, just to clarify, on the funded account, you can be based anywhere in the world. We're all aware of the issues, particularly in America, for the particularly trading Forex. It's quite difficult. As we know, well, this is not the issue as far as the funded account is concerned. We will be taking customers from all over the world. I'm not going to explain the reasons how we've done that, but we can. This is, and it's all within, obviously, the legislation. So it's a great opportunity, and as I say, it makes no difference where you are based in the world. You will have that opportunity to join the fully funded program. So thanks for coming along today. I hope you've enjoyed it. Hope you've learned perhaps something you didn't know before you came along. Enjoy the rest of the trading day. The VIX is still ticking up. It's now breaking away from that volatility candle on 10, so it looks as though it's continuing higher for the time being. So we know what that means. We will be back next Tuesday morning for the London Forex session at 7:45 as usual. Or alternatively, we will be back next week, this time for the US session at 3 o'clock. So enjoy the rest of the trading day. Stay safe and stay well in these difficult times. And enjoy the rest of the trading day. Have a great week ahead, and we will see you next week. So thanks very much for coming along. We do appreciate it and hope you've enjoyed it, and bye for now.